And in three, two, one. Hello and welcome to another episode of Guide to the Grind. My name is Jeff Eady. This is I've already screwed up the intro, Jonathan. We had 2 weeks off and I'm already hurting. Welcome to Guide to the Grind, where we cover money, mindset, and momentum. Joining me today, as always, one of my best friends, one of Canada's favorite mortgage brokers, and the Starsky to my Hutch, Mr. Jonathan Tilger. Jonathan, how are you today?
I am absolutely phenomenal. Jeff, yourself?
If I was in a bed, there'd have to be two of me, sir. I'm super excited to get to our guest today. We've been off the last couple of weeks. Happy to get back at it, JT. And I hope I don't butcher my first intro after coming back here. So got to pull it up here. Stands as an exceptional force within the realms of technology, innovation, startups, and angel investing. As both the managing partner of Cortado Ventures and a distinguished Kaufman Fellow, a prestigious program reserved for the top 1% of venture capitalists, he possesses an extraordinary knack for identifying and propelling growth-centric technology companies. His extensive experience as an entrepreneur, technologist, and visionary makes him a captivating guest for any podcast. So I got to skip down here. He is a former Air Force captain and an Afghanistan veteran. Also has been chosen by the Oklahoma governor to chair the Workforce and Economic Development Council and appointed by the Oklahoma City mayor to oversee $777 million in infrastructure and quality of life projects. Please welcome to the show. Gosh, I'm killing it today, Jonathan. Please welcome to the show, managing partner of Cortado Ventures, Nathaniel Harding. Nathaniel, how are you today?
I'm doing great, Jeff. Thanks for having me.
Yeah, thank you for being on the show. As we were discussing just a couple minutes ago before we got on here, venture cap is one of those things. It's like a shadow in the night in the world that Jonathan and I live in. It's something you hear about. It's something we know is necessary, but we don't really know a lot about it. Can you explain a little bit about Cortado Ventures, how you came to be where you're at, and how you work? Actually, first thing first, thank you for your service and what you did in Afghanistan. Really appreciate that.
Thank you. Thanks for saying that. And actually, quick note on that, I got to work at the U.S. NATO headquarters, so I actually worked with some service members from Canada and other countries as well. So got to see the world. Yeah, venture capital is a lot of fun. I mean, I think there's some mystique around it. Partly because it sounds cool. It has the word venture in it. But also, I think because we invest in companies that aren't known, broadly known yet. And so, we invest in companies that may not even have a presence in different databases that people look at, like PitchBook, or that you can't find online. And so there is a certain kind of mystique about, the venture capital firms that invest in these companies that before they're famous, right? So a lot of big names, now publicly traded companies, got their start being backed by venture capitalists, and really we're investing in companies that in many cases are pre-revenue or very early revenue. I mean, I'm talking like $10,000 a month kind of, first customer, revenue level. And that's early. And in fact, sometimes I like to say we invest at the stage where a founder is graduating from the garage. Maybe they've been tinkering in the garage or their basement or their house, whatever, or it's been a side project. And then we are the first institutional investor. And then that founder can now maybe hire the first handful of people, get a real office, incorporate and start to really commercialize their idea.
So that sounds like a really hard thing to underwrite. How do you go about, well, A, finding the companies, but B, making sure you're not just throwing your money at something that could disappear in a year, especially in the technology realm, because it could be obsolete within a couple of years.
Yeah, it's interesting because we invest in some things that maybe borderline sound crazy, and like you almost like want the sweet spot of like that sounds crazy, but also maybe awesome, and not sure which side of that fence it falls on. But you can essentially describe risk in a few different ways. One is product risk, like does the thing work? Whether it's software or hardware, whatever it is, like does the thing like functionally work or does what it says it can do? And then there's market risk. Does anybody care? And are they willing to pay for it? Does it give the customer enough value or ROI? And there's execution risk, which is which that's kind of almost an order. And then execution risk is, okay, the thing works, people care and will pay for it, but now can this team grow and scale and maintain margin and capture the market? And so really trying to understand where a company is, because we use phrases like pre-seed or seed or angel, Series A and beyond. We care less about the semantics of how you are calling the round that we're investing in. We care more about what level of how many of those risks there are. If you have all three risks, that's truly the earliest stage, and that might even be the idea stage. And that's actually a bit too early for us, but we do work with some partners like accelerator programs and university programs that can work with the founder to get through the idea stage. But then once you get through that, we'll underwrite to those risks. But really it's a pricing discussion. And if it is that early, and this might be interesting for people that maybe don't understand how early stage investing works, you wouldn't necessarily put a price on it. In other words, you wouldn't negotiate a share price and a company value. You would do a convertible note, or something called a standard agreement for future equity, or a SAFE, which is basically it's an agreement that says when your company hits a certain milestone, I'll have this amount of equity of whatever it is. So it's kind of a way of kicking the can down the road of saying, like, who knows how much it's worth right now? We all think it's going to be worth a lot more later. We're first money in, so we should get extra credit for taking that risk. And so we'll convert to equity at a preferred value relative to later investors.
So you're saying convertible note. Can you just explain what that, I mean, you talked a little bit about it right there, but does that mean that you're effectively charging them interest until it converts over? Or what's the mechanics on that?
Yeah, it's a good question, and I'll even break it out. Let's put a SAFE over here because a SAFE is technically different. So, but a convertible note is a debt instrument, and there is an interest rate, and almost always, it compounds and then converts. It adds to how much equity you convert into when there is a conversion event. And so, usually, a conversion event would be when the company raises a certain amount of money. So, let's say we're investing $100,000. Literally lending $100,000 that has a maturity, has an interest rate. But then in the document, it may say, but when you raise $1 million from somebody anywhere, whatever value you all agree to, like, we're going to convert into that. Like, we're going to become equity holders. Like, our debt's going to go away. And instead we're going to convert into equity into that company according to some formula. So basically like maybe a 20% premium. So it won't be 1-to-1, like we'll get a 20% boost. And also whatever interest had been compounding, like we don't make them pay us interest. The money is there to build the company, like not for us to get interest. But as the interest compounds, then that's also kind of like extra little boost. So if it's like a 5% interest rate over 2 years, then basically another 10% boost into that equity when it converts. And so you can think of the interest really as more of just like another way to juice your equity conversion, since you were like that early money in. Now, with a convertible note, people don't do that because they like to make loans, because we invest in upside. We're not here to draw interest on things, and so we're there's not really much you can collect on, and so it's not really something where you can say, oh, you didn't pay us back, and so we're going to repossess your car. You really don't even have those covenants or that ability to do that. So it's all really just designed to say, we're going to structure this in such a way that we'll get a preferable conversion to equity when that happens. So that's convertible note. And then real quick on a SAFE. A SAFE is actually technically not a debt instrument. Some people argue that, but they're wrong. But a SAFE is really just a piece of paper. There's no interest rate. There is basically a premium or a discount rate, which is kind of confusing phrasing, but it basically says it actually works the same way in terms of when you have a financing happen, I'll convert to equity with like a 20% booster, but there's no interest rate and it's not technically debt. It's not carried on the balance sheet. There's no maturity, things like that.
Now, one thing I'm very curious about, and you talked about I'll say the execution risk, which really comes down to the team that's there. Can they get done what they say they can get done? We determine, yeah, there's a market there, the product's good, all that. what are the main things you're looking for in that team? Do you like how in depth do you get involved with them? I'm assuming you interview most of the team members, but what's the process you go through to make sure these people can do what they say they can do?
Yeah, it's definitely more of a dark art, right? It's not like a science. I mean, there are some things that certainly are helpful. Like if somebody has experience doing that, like if somebody's on their third turn of doing a startup and their first two were great successes. Um, but oftentimes that gets priced in, and right, so we're in the business of kind of information asymmetry, or like we know something that others don't or can't know, or we're just accepting a risk that nobody can de-risk except for just time. And so we instead, we focus in the middle of the country, an area we call the mid-continent. And part of our thesis is we want to invest in overlooked founders, people that aren't coming from Stanford and kind of took the standard path, worked for Facebook and then starting their own company. We love it when somebody comes from industry and saw a better way and now wants to start, build their own technology. Some people would call it deep tech. It's basically a reference to something that's maybe a digital technology applied to like a physical, like to the real world, as opposed to pure software. But it requires a lot of industry experience. But what we look for, some of them are just personality traits like creativity and tenacity, because when it comes to being an entrepreneur, an early stage entrepreneur, things will go wrong. How resourceful are you? And then you might ask, well, how do you even infer that besides just asking, are you tenacious? Are you creative? Um, so some of it is when you have an early stage founder and they've already are like surrounded themselves with people who are taking on these different roles, that's actually like a red flag. Like you want a CEO, founder who's like, it's just me. I'm gonna have to do it all for now until I can, raise the capital, have the revenue to bring people on. I'm gonna be the top salesperson. I'm gonna get the first 10 customers and make them wildly happy and really iterate the product. And I'm gonna figure out the product. And so you can actually really sense how creative and resourceful somebody is with like how much they're like taking on that they're going to figure out and do themselves, as opposed to thinking that they can just say like, well, I'll have somebody else do sales because I like to fidget with the code, or vice versa. Like I like doing sales. I don't know about that. I don't know about building a product. I'll have somebody else do that. So those are some of the ways that you can actually point to something and say, that's a good attribute or bad attribute for a startup founder. Um, and I think somebody who did come from industry, like I said, that has really seen the problem from the inside. And because especially we're investing in areas like deep tech that require deep domain expertise. And so you can't just have a hobbyist come by and say, I'm going to figure out how to improve refineries. Like, well, it's really hard, so it's better to have something that comes from that space, for example. So that's another attribute that you can point to. And yeah, some of the things that we just look for as we try to underwrite, like, is this the right person for this plan?
Now, is that sector agnostic, or do you think that's something that kind of plays across all venture cap investors, that they're looking for that tenacity in the entrepreneur?
I think that's true across, I mean, any, when I talk about venture capital, we talk about things that are massively scalable, high margin. So as opposed to like, there's other great businesses out there that where venture capital isn't a great fit. And that's like a very different kind of entrepreneur. So yeah, specifically, I think if you're a venture capital investor, regardless of what sector, you are looking for that kind of, creativity, tenacity, resourcefulness, high trust, and high communication. I want to add that too. And that you also can infer from your conversations, because if somebody's following up and doing what they said they would do and is being forthright and not trying to hide things, I mean, so those are all things that you can pick up from those early diligence calls. And I do think those are transferable across any kind of VC investor. The deep domain expertise maybe is a little bit different if somebody's investing in, an area outside of like deep tech, for example.
So, do you come in with smart money or dumb money?
Wait, which one am I? Like, am I smart money or dumb money? I hope I'm the smart money. No, so if I think I know what you're getting at, so we know we're doing it right if the founders really want our money, if that makes sense. And you may say like, well, everybody wants money, but let's say, the counterpoint is, maybe it helps illustrate what I'm saying is, so if I decided tomorrow I'm going to be a later stage investor, I'm going to focus on like pre-IPO. Well, now I'm going up against Anderson Horowitz and Sequoia and NEA and BlackRock and Blackstone and all the other rock related company firms. And so uh and I don't stand a chance. Like I'm like the 1000th choice for any founder in that space. And so if I'm winning a deal, then that's adverse selection. It's because everybody else said no. So instead, like I want to be the hot shit for that founder. Like I want to, like when somebody, you know, it wins an investment from us, like we want to both be thrilled and we want it to be both be a positive signal. Like we want to lead the round and bring others into the, like we want people to, like other investors to say like, oh, Cortado's in, like that's interesting, I want in too. Um, because then that puts us in a powerful like lead, like catalyst type position, but it also means that we're winning the best deals, right? So um, if people are kind of competing, to have us on the cap table, then that means that it puts us in a good position to, for the opposite of adverse selection, positive selection, good selection. So, but I also don't want to be too early, because then it's just a misfit for our skill set. And also now all of a sudden we're like underwriting all three risks, and and that's just not where we're best suited. And so, yeah, as any investor that's kind of focused on a stage, you want that Goldilocks of like, not too early, not too late in like the life cycle of a company. And we don't always get it right, and we're always kind of figuring out like what really is our sweet spot. But I can't, we believe it's post product, pre or early revenue. Many people would call that seed. Some late pre-seed, some early Series A, and but then we play a really pivotal role in bringing in other later stage VCs, or just other VCs into that round, or later stage VCs into the next round. And we've actually done that over 70 times. We have over 40 portfolio companies, and now over 70 times we've brought in like other big name investors, into competitive rounds, and that led the next round and added to the board. It became like like the next great fit for that company. Because we also don't view ourselves as like we're going to be on the board and be the best fit for the company forever. There's going to be a natural exit where I say like I'm ready to roll off the board because my skill set is no longer the most value add. This other investor is coming in. They're more of a pre-IPO investor. They know how to lead you to Wall Street, so they're going to take the board seat. So that's how we view the world.
So, this is awesome because I don't often have like 10 questions at the same time that I want to ask. This is really interesting to me because Jonathan and I work a lot in the later stages, and not understanding how the partnerships work at this level. So when you come in with the entrepreneur, are you coming in with strategic growth strategies? Are you coming in with introducing them to partnerships possibly in that space aside from capital? Or are you just saying, let's see what happens?
Yeah, we have a few things. We try to hit the right balance of like, we know that the founder and that management knows that company the best, and so we're not coming in to kind of mansplain like, here's how you need to do things, but we do want to be like available and helpful. And so what that means for us is we help in a few ways. One is we provide fractional accounting. So if the company is not quite ready to bring on their own accountant, or in some cases not even ready to have like a true outsourced fractional accountant, we actually can provide that as kind of training wheels for a while until they can kind of get to a point where it makes sense. We also help with recruiting. So we have somebody on our team, somebody that we work with, who is a professional tech talent recruiter. And so she works with all the companies on finding like the best person to fill whatever role they have. We'll help with PR if needed. So we'll say, okay, you landed this deal. We should tell the world because it's going to send a big signal and attract other customers like it. So here's our PR firm. Let's help you write a story for this, or something to help get the word out. So help with PR. And in some cases, intros. And so we have about 100 LPs, limited partners, investors in our fund, many of whom are CEOs in the same sectors in which we invest. So in many cases, we'll make connections for the benefit of our portfolio companies. And one time I asked one of our companies, give me 15 like dream customer names. And I knew the CEOs or the top decision makers and most of them, and made connections. And it's up to the company to go out and earn their business. But that was a concrete example of helping kind of market access. And then lastly, and I think this is the most unique. I keep saying this out loud, hoping that at some point somebody will be like, "No, we do that too." But I'm going to keep saying it until somebody says that. So I believe we're the only like smaller seed stage fund, so not an Anderson Horowitz or Sequoia, that provides at no cost to the port co-founder executive coaching. And I mean like blue chip executive coaching. So with our partners, Magellan Executive Partners, they have a team of 25 former CEOs who advise and coach and get paid to do it, companies all over the country. Well, for at no cost to our portfolio, they get executive coaching for as long as they want it. And
That's massive.
yeah,
Massive.
and that's even better than a board seat because you're actually getting like confidential, like you're asking the questions that you don't even know that you need to that would be brought up maybe in a board meeting, or you're able to have like that confidential kind of candid feedback before you decide like, okay, here's the decision point, or just advice from somebody who's been there and done that, so that way you can cut your mistakes in half, right? And so that's a big part of that's probably our most unique value add.
Other people's experience is hugely valuable. What is the size of the loan that you guys, well, the size of the investment that you would normally make in a company?
$1 million. And so we'll do as little as like 250, 350 in like a pre-seed company, and do as much as 2 million in like an early series A company, targeting 7 to 10% equity. And then we'll do follow on. So we'll triple down into a company, if they're hitting milestones, and we're excited about the company's future, to a point where we can triple down twice. So we can end up investing as much as $10 million over time into one company.
Now, in terms of your investors, is this kind of all your money, or do you have investors who put money with you?
Jonathan, get out
Oh
of my
man,
head.
I wish I were that rich. No, so yeah, we manage over $100 million across two funds, and we raise that from other investors called limited partners, and so we have so we fund one was 20 million, fund two 80 million, and that's from about 100 different investors, which includes individuals, family offices, institutional investors like hospital foundations, university endowments, state agencies, banks, and so those investors commit to our fund, and we call capital over time. And it's a standard, like it's the same structure as you would find in Silicon Valley in terms of you have the limited partner, fund. We, the general partners, manage the fund according to standard language so like once the capital is committed, then it's our job to manage it. So we're not like surveying our investors every time we're doing a deal. It's really like they're entrusting us to go and do what we said what we would do. And we have a team of 10. So here in the office, team of 10, more than half are on the investment side, either fully or a significant part of the role has to do with investments. And then the rest being like portfolio support or like post-investment support. And some people are either maybe on like on PR communications or administrative.
Because the very interesting part I find on the investment side with your with what you guys are doing. Because I mean, my main thing in my background is all in mortgage and mortgage lending. In mortgage lending, just to bring in sort of a baseball analogy, it's like you're going up to hit a base hit. High percentage of doing it, base hit, base hit, base hit, you get small return. Whereas you guys, you're effectively going up to hit home run every time, knowing that you're going to have a higher percentage of strikeouts, a higher percentage of outs to do that. But when you hit the home runs, you're getting big payoffs. Can you just talk a bit about that as far as raising money, talking to investors, just that side of it where, yeah, you know that you're going to invest in this many companies. You know that some of them are going to fail along the way. That's just part of your reality. Whereas on the real estate side, the losses are much less. So can you just talk a little bit about that side of it?
Yeah, there's something called the power law. And so if anybody remembers if they took statistics or have just seen a bell curve, right? A distribution of people's height, for example, would fall along some kind of bell curve. Most people are between 5'2" and 6 feet. And then there's, kind of the small tails of people on the other side. A lot of investing looks kind of like a bell curve. And that might be analogous to like real estate investing like we were describing. Whereas in venture capital, it's the power law curve, which is basically it starts off extremely high and then drops off and has a really skinny tail. So in other words, you have a few companies that deliver just monster results, maybe a few more that are like pretty good, and the rest are like 1 to 0, right? And that also means that your average and your median are far apart. Like in a perfect bell curve, average and median are the same. But the more skewed you get, the further apart it becomes. Like the average, VC returns like may sound like really good. I don't remember the numbers off the top of my head, so that's why I put it that way. But then all of a sudden, median like doesn't sound good because the median ends up being, pulled over by the bad results. And so, in other words, as a VC investor, it's extremely important, or as somebody who's investing in a VC fund, finding like the top decile or top quartile performers is wildly important to actually get the kind of results that you expect out of VC, kind of risk adjusted returns. And it's because of what you just described is every investment we make, we need to be able to math out that it can return the fund. In other words, like when that company grows up and exits, that we can return like if it's a $20 million fund, then we'll make $20 million off of that one investment. Now, obviously in reality, statistically, something like 70% are going to be zeros or 1 or less. And you'll have some doubles and triples, and then a few just fund returners. And so the more that you can kind of plow your capital into your winners, and that's why we do a smaller check at first and then invest much more as the company is hitting milestones, is we can just work our way more into the winners to take advantage of that power law function. And so as an example, we have some companies that are up 20, 30, 50 fold since we invested 1 or 2 or 3 years ago. And lastly, like the nice thing about it is since we don't use debt, we can never be less than 0, right? And so like it's actually a little bit of a comfort knowing that like if you're starting at 1, the worst you can go is 0, whereas the highest you can go is like 1,000. And so whereas in investment structures that are leveraged, you can go to -1 or -10, right?
What's the process look like for a business owner that you invest in and say they completely screw everything up? Do you go after money, or is it just a write-off against the rest of the fund?
Yeah, so we and the other VC investors, the other investors in general, do not own a majority of the company. And even in the aggregate, even if you combine all the investors, do not own more than half. So in no way do we control the company. Now there's some protective provisions that say, a change of ownership or control can't happen without consent of the preferred shareholders, the investors. So there are some controls that we have, and being on the board, in some boards, the investors actually may make up most of, or or at least or like 2/5 of the board and with one independent board member. So there are ways to replace the C-suite, if needed. That's pretty rare. And at least in these stages, it's actually, if you look at the life of a company, you have like startup CEOs and then Wall Street CEOs. You have the CEOs that are like awesome at starting, but at some point, like their skill set becomes less relevant. And a lot of times they're self-aware of that. And sometimes they can grow into it, but it's not uncommon to then see in kind of that pre-IPO stage, like a new CEO come in and maybe the founder becomes, just a board member or CTO or something else, but still like involved, but not the top person because they're just not like the IPO kind of CEO. But yeah,
I
in some
gotta
rare cases, you got to make a change, and it's almost always like collaborative. It's almost always like, okay, we all recognize we got to make a change here, but sometimes it's not.
I gotta say, this is very different from my perception originally of venture cap. I don't know if you ever read Success Magazine, but Darren Hardy used to be the editor, and he put out audios every month with it. And one of the things he was talking about for entrepreneurs is that when you decide to go to angel or venture cap, and by the way, is there a distinction between those? Let's put a pin in that. You've effectively decided to sell your company, and that doesn't seem like the case here.
Oh, well, actually, I can see what he's saying because those kinds of investors, our VCs, we are ultimately targeting an exit. And so if a founder is saying, I want to own this company for the rest of my life and I want to pass it on to my kids, then yeah, VC is a terrible idea. But if a founder is saying like, I'm totally cool with not always being the CEO and the majority owner, I want to get liquid at some point with it, then an exit's totally in my plan, then yeah, VC could be a good fit. And so yeah, VC investors, that's how we make our money, is the company eventually either sells completely or mostly to somebody else, or goes public, and then we can all sell our shares after a lockup period. There's other ways that you can, as investors, get liquid from an investment. One is through a recapitalization. So let's say we invest at seed, and then years later the company's raising a Series D. Well, a growth equity firm comes in and wants to clear out the cap table, like buy out all of us early investors. Well, in that scenario, maybe the founders like still own most of the company, but us early investors were able to liquidate out. So I mean, there are ways for us as investors to liquidate out of a company without the founder also having to liquidate. But I can see why somebody would say, like, if you're getting money from VC, like, you need to just have the mindset that at some point you're not going to be the guy and you're going to sell, mostly or fully out of the company.
That's interesting. So you started to talk about my next question. Actually, no, let's go back. Sorry, having too many questions that I want to ask you. This is a really interesting topic for me. Is there a difference between angel and VC?
Yes. An angel investor is an individual using their own money, whereas a
Okay.
venture capital firm is somebody like us who raises money from others. We have some SEC requirements. We're actually what's called an exempt reporting advisor, and almost all VC is. It's an ERA, exempt reporting advisor, which basically says we don't have to actually register with the SEC as long as we fill out some paperwork showing why we're exempt, which is funny. It's like, you don't have to register as long as you register showing that you don't have to register. Whereas if you're just like a rich guy, you just do whatever you want. Like, you're not selling shares or like LP interest for a fund. You're just investing your own money. So yeah, an angel investor is an individual, whereas a VC firm is a company that raises money from other people.
Thank you for
And to be
clearing that
clear,
up.
like, I also put my own money into the fund. But as soon as you raise money from any other investors, then you flip the switch from angel to VC.
And what's the timeline like for a company that you're investing in? Like, do you have a set timeline, or if it keeps going great, we can stay in there for 10 years, or, we're out at 5 no matter what?
Ideal is like 5 years. I mean, if you see a pathway for 3 years, that's great. The fund life is 10 years, and we have 4 years to invest the money. So the whole fund life is 10 years. We need to get the money out the door in the first 4 years. And then the remaining 6 years need to focus on kind of harvesting or eventually liquidating out of those companies. And so let's say you can do like 2 1-year extensions, which is pretty standard, or like 1 year, 1 2 year. There's ways to extend it a little bit. It's like, let's say you're in year 10 and you have like 1 company left and they're about to IPO. It's going to be awesome. It's going to be huge. You could, with your LP's permission, extend it for a year or 2. But at some point you have to get out of a company, and let's say the company's not in a position to sell. Well, then you can sell your shares on the secondary market. So you can just go out there and say, hey, Cortado is tapping out of this company. The company's great, or it's not, whatever. Like, we need to get we need to liquidate our shares. So we would then have to find a buyer to buy us out, and they take our spot on the cap table.
That's really interesting, because we had a guest just before Christmas, Kyle Mowry, Jonathan, and they do post IPO equity. So that's kind of interesting. These are areas that I just didn't even know. Well, I knew they existed, but I didn't really understand them. It's kind of neat to see how they fit together like a puzzle. I have more of a personal question. How the heck do you go from Afghanistan to running a venture capital firm?
Yeah, I mean, most of my career was as an operator and entrepreneur. And so after I graduated college in 06, I worked for a large oil and gas company. And then I came back home to work for the family oil and gas company, which I worked my way up and then ended up running operations. And we had a great exit in 2014. And then I did a couple more turns of my own with my partner, Kevin Dennington, running oil and gas companies. And the theme of my career, really from like 06 to 2019, was working in, operating, starting, selling, raising money for oil and gas exploration companies driven by technology. And so really the relevant connection there was I saw the power of bringing in technology to innovate in a legacy sector, and being at the tip of the spear on new developments, new discoveries, new uses of technology, and working with outside capital, executing a plan, and selling. And so so I come from an operator entrepreneur background, but also during my career from like 09 to 17, I was in the military, a reservist, and I did deploy in 2012. And so in 2012, I was activated, but otherwise I was a reservist, kind of doing the 2 weeks a year of training and the weekend duty. So yeah, that's how
Okay.
it all fits in. Yeah.
That makes a little more sense.
Yeah. Well, in the military deal, so actually I worked, like when I deployed in Afghanistan, I worked with logistics and intelligence, specifically like geospatial intelligence. So it's like satellite imaging. And so some of that experience actually even works into what we do now as investors. Like, for instance, one of our companies is called NewView. They just had some big news this week, actually. They acquired another company, but NewView uses LiDAR on satellites. LiDAR is what self-driving cars use to see. But imagine putting that on a satellite and able to image any surface on Earth. Nobody's been able to do that yet because it's really freaking hard. But NewView has figured it out, and they have significant traction. It was reported recently by TechCrunch, so I can say it out loud, but they have over $1 billion in signed customer agreements. And so once they launch satellites, they'll be realizing that revenue. And the use cases are energy infrastructure, it's like monitoring pipelines, monitoring crops, defense. And so you have, I mean, it's I would have loved for NewView to have existed 12 years ago when I was in Afghanistan. That would have saved us a lot of time. My deployment could have been a lot shorter, but it just kind of connected the dots on like military, entrepreneur, Cortado.
What sector of technology gets you most excited right now?
I mean, I've always been an energy guy, and so I mean, traditionally, I've as an entrepreneur, it was oil and gas, traditional energy. But as an investor now, of course, I love the idea that innovation is going to find new ways of generating power and providing our energy needs. And so there's always new developments in energy or storage, like batteries, that I think is really interesting. And but I also, a niche that we're kind of developing as investors is finding companies that are working with the existing infrastructure and making it cleaner. But also, like, that's the value proposition. And so, an example would be one of our companies, OPRO, uses AI in refineries and reduces the power needs and increases the output. So that's great because it reduces the environmental impact, but it's also addressing the massive existing infrastructure to be able to, and that's how it's delivering value to customers, is lowering costs and increasing output. And it's using AI in this kind of novel way in this built environment in a very complicated setting. So I'm excited about seeing when I see like digital technology in the built environment, solving like really complex problems, because that's really, I think, where things are headed. The easy stuff's been done, so it's all the hard stuff from here on out.
How would a company find you? So you've got a company who is somebody they've been growing, they're at that point, okay, I don't know where to go. I know I need money, but how do they find companies like yourself, and how do you actually find the companies that you work with? Do they get brought to you by people, or do they approach you direct?
Yeah, so a big part of our job, since we invest in companies that aren't on PitchBook yet, and by the way, PitchBook is one of the services out there that somebody can use. You got to pay for it, but you can use to find companies and investors really for all asset classes. But a more affordable one is Preqin. I'm just putting plugs out there for people to. I mean, these are like real things I wish I had known years ago. But we invest in companies that aren't on those platforms yet. And so a big part of our job is to create enough of a brand, and enough of a market presence to where we have that brand pull where people come to us, right? And so we get a lot of cold emails, and and I'm no stranger to cold emails. I mean, that's actually like the first time I raised money as when I was an entrepreneur was cold emails, like just straight up, like I used mail merge and just like lit up people's inboxes until I landed a meeting. We raised a lot of money. So people coming to us and like us having our brand out there and being considered a thought leader because we publish content. And so we're very active on, we actually have our own podcast called the Midcon Markup. And so we can like cross market each other. But we try to really kind of put our thoughts and our and what we're seeing in the market and the kind of companies that we want to look at and meet. We just put that out there, and we do things. We have different events. We have like founder happy hours. We'll be playing pickleball with founders here in a few weeks. We're
The
hosting
scourge of the tennis court.
I know. Yeah, my knees hurt thinking about it. But and then we host the Mid-Continent Venture Capital Summit every May. It's going to be in Bentonville, Arkansas, May 9th. And the first one we did last year was absolutely huge. Standing room only, 250 people, about $10 billion represented on stage across investors and founders. Like big names, New York Times bestsellers, feature on CNBC, unicorn founders, but also people like just starting on their journey, pre-idea or idea stage. Yeah, so marketing events, but another specific area where we can get deal flow is by partnering with organizations that work with early stage founders. So like right now, I'm in an incubator called The Verge, vergeokc.com. And The Verge is an independent 501c3 that's the entrepreneurial hub for all stages of founders from idea through funding. And so there's various resources. I mean, down the hall, there's a IP attorney, an accountant, and a accelerator, a biotech startup program, a coding boot camp. So, I mean, we are co-located in 17,000 square feet of space with The Verge that attracts early stage founders that have ideas and want to work on getting them out there into the world. And so just by bumping into people or by attending the different programs they have, um, the demo days that they do. And those are all opportunities for us to see companies at that early stage. So that's like a whole kind of class of deal flow where boots on the ground, we invest in areas that we can get to in a day, that if we can have boots on the ground and be and physically present for these opportunities to meet these founders, then that's a powerful way to find these companies early.
Hmm. Now let's talk about the other side, the investor side. Do you deal strictly with institutional level investors, or you take on high net worth or accredited investors?
Yeah, we have a mix. It's kind of an 80-20 split. Like 80% by volume are individuals and, let's say, smaller family offices. And then, and 20% by number of investors, but 80% by dollar value are institutionals, like hospital foundations, university endowments, state agencies, and banks. And also what I would call an institutional family office. So the difference kind of being size and infrastructure, and kind of how they behave. Like first generation smaller family offices act more like individual, whereas like third generation multi-billion dollar, like 20 people on staff family offices act more like a pension fund. Right.
Yeah.
And so kind of 80-20, 20-80, split on investors. And both are great because our individual investors provide us deal flow and validation, as well as pilot. Some of them become pilot customers of our companies.
And
Institutional is great because they have big checks and they can have a long-term view, so they re-up in subsequent funds.
sorry, one other question with that is, like you said, you have two funds right now, and they have a 10-year cycle.
Mm-hmm.
Um, are they close-ended funds then, or do you take on new investors at any point in time?
Close-ended, yeah. And so we raised money for the first one in 2020 and 2021, for the second one, 22, 23. And so, yeah, at some point you have a final close, and the number is the number and no new investors. But then in a couple of years, go out for another one. There's certain self-imposed rules that are market standard that you have to have deployed so much of your previous fund before you can go out for your next one. It's a focus thing, and it's avoiding conflict of interest.
Just curiosity question here. Have you had I'll say a client who you brought in, they had a company, they had a successful exit down the road, who have then taken a large portion of what they made and invested it back with you?
We've had that happen multiple times, but simultaneously. So we're still pretty young. We started in 2020, so we're still preschoolers, and so we'll have our first exits this year, which is great, to hit a schedule. It's a great performance, but we actually have several. Well, let's see, three that I can think of immediately, who are both founders of portfolio companies, CEOs of portfolio companies, and also investors in the fund. And that actually brings up, I forgot one other area of deal flow, which is maybe kind of like a subset of like the ecosystem. So I described like accelerators, university programs, coding boot camps. Let's call that like ecosystem building. So maybe a subset of that is we sometimes will incubate companies internally. We partner with a venture studio called 19 Days, where it's kind of like VC Inside Out, where they come up with the idea first and then build a company around it. We'll also incubate a company where like one of our LPs has amazing industry experience, partnered with our venture studio, built a product, and then launched a company. We haven't actually announced this yet, but I can just describe it generally. This company was formed at the beginning of this year, and they've already almost reached $1 million in annual recurring revenue.
Wow.
So that's the fastest in our portfolio to reach that benchmark. I mean, like 45 days. Normally that takes like a year or two or three. And so another really powerful, like unique way that a firm like us can source is to build it yourself. Now that's high labor, so you don't do a lot of it. We maybe do like one or two a year. But it's a really powerful way because you get ground floor access. You've already de-risked a lot, because of how just inside of the deal you are, and kind of know again, that information asymmetry, like we know lots of things that others don't because we helped build it. And we also do that through an entrepreneur in residence model where we'll have a successfully exited CEO join us temporarily as a team member, and they'll be out there looking for the next deal while also helping us as an investor. So that's another way that we like create companies. Like they'll end up taking over a company that we seed, and so that's another version of that incubation model.
This has been absolutely fascinating. I can't believe we're actually at the end of our hour already. Thank you so much for this, Nathaniel. Is there anything you want to leave our audience with, whether entrepreneurs or investors, anything that you'd like to pass on that you haven't been able to say yet?
Yeah, I mean, definitely reach out to us if you're want to know more or read about some of our thoughts and insights and how we do our process. See our portfolio. Reach out to us if you're building an amazing startup or if you want to invest. We're easy to find. Our website is cortado.ventures. And then all of our social media handles are just Cortado Ventures. And we definitely, even if it's not a fit as an investor, we love to help and kind of point people in the right direction, or if it's too early, help with resources and how to get to that next step. But what I bring and what my co-founders bring is we've all been in those shoes as an entrepreneur and operator. We've all had to raise money, and know that is difficult, but it's absolutely worth it. And so hats off to the builders out there.
Well, thanks so much. This has been enlightening. Honestly, I wouldn't say I had the most favorable understanding of venture cap before this, but now it actually seems like you guys care and you're not just after the money. So thank you for that. That's awesome. I love when I can have a whole new perspective on a sector after interviewing somebody. So that's amazing. Thank you.
Yeah, well, thanks for saying that. It's been a great experience for me. So thanks for having me on.
Yeah, absolutely. JT, anything you want to say to wrap it up?
Hey, Nathaniel, just great speaking with you. I learned a ton. I learned a ton from this, and love what you guys are doing. Just it's just it's a very needed part of the market, and you need people who know what they're doing, who can help get these companies going, just get them the funds they need to get to the next stage. So thank you.
Yeah, here. Well, thanks, guys. It's been a pleasure.
Awesome. If you just hang out for a minute after we sign out here, Nathaniel, let's chat with you just for a minute afterwards. Thank you for listening. If you've made it all the way through this podcast, please don't forget to like, subscribe, share, comment. All those things really help us get these messages out there. And I certainly know after conversations like this, there are a lot of people that benefit from this. So thank you, Nathaniel. Thank you, Jonathan. Thank you for listening. If you want to know more about us, you can certainly go see Jonathan at amortgageplan.com. Find out more about myself and Jonathan at guidetothegrind.com. Until next time, thank you, gentlemen. Thank you for listening. Have a fantastic day, and we'll see you soon.